Hello, everyone. This is Ernie Humphrey, CEO of Treasury Webinars. I'd like to welcome you to our webinar today, Intercompany Financial Management, Benchmarks, Challenges, and Expectations. Before we dive in, first and foremost, I want to thank my thought leadership partner for today's webinar, Blackline. They share my strong commitment to thought leadership, but also empowering the career success of professionals up and down and across the office of the CFO. So let's go ahead and cover a few housekeeping items here. Then we'll take a quick peek through our agenda, and then I'll welcome my co-speaker for today's webinar, and then we'll jump right in. So anyone interested in receiving a certificate of attendance for today's webinar to submit for CTP credit or NASBA credit or another professional certification, you'll have to answer all the polling questions and remain online for the duration of the webinar. You can send an email to Ernie@treasurywebinars.com. Also, if you'd like a copy of today's presentation, please send an email to Ernie@treasurywebinars.com. We'll also be launching a very short survey at the end of the webinar today, as we always strive to improve the ROI we offer our attendees for your valuable time. We know there are more and more webinars out there. We still are confident that ours are the best and give you a unique experience. But that being said, we're always looking to get better. So please share with us your feedback. So before I jump into the agenda, I'm really excited about this topic. I get to dive in to an area I haven't been. It's been a long time. I was a long-time treasury manager at a fast-growing manufacturing company, and we had an awful lot of intercompany operations going on, all the accounting, all the pricing, and I really wasn't as involved in that as I should have been. So I was really happy to see when Blackline made the acquisition of 4Q, really focused on delivering value. And so first thing we'll do is I'll let my co-speaker Wade jump in and really explain what intercompany financial management is. It's really a term that is a pretty recent term. I thought it made sense to me, but when I thought back on it, when I was in Treasury, there really wasn't that term. So for me, someone said intercompany, it was a transaction. It was something I wasn't involved in. I wasn't involved in the transfer pricing. I wasn't involved in the timing. I certainly wasn't involved in the accounting. And all these things are tremendously important. And what you will see is that intercompany financial management done incorrectly can have huge impacts on the bottom line. So then what we'll do is I'll dive into to our intercompany financial benchmarks, challenges, expectations, and survey overview. Then we'll talk about, of course, getting started, why intercompany matters. Then we'll talk about, we'll start diving into some survey results. We'll talk about the state of the union, what we see in the marketplace, and I'll bring in Wade for his thoughts as well. And then we'll really talk about how IFM done right, how to leverage technology leading solutions out there, and Wade will drive us through that. And then we'll do a quick peek at some of the survey results for intercompany, looking forward a little bit, and then we will offer some closing thoughts. So before we dive in, let me go ahead and welcome my co-speaker today, Wade McPherson. He is a solutions architect for IFM at Blackline. So Wade, first and foremost, thank you so much for joining us. Can you give us a little bit about your background and what you do at Blackline before we jump in here?
Thank you, Ernie. I really appreciate the opportunity here. Yes, absolutely. My name is Wade McPherson. I have a background in accounting and specifically intercompany accounting. I used to manage intercompany accounting for a large multinational for many years, and now I am in the software world, helping develop tools and helping our customers solve their intercompany challenges from a technology perspective. You know, it's a lot of folks have processes around it that are manual, they're complicated, and I was in that world prior to coming to software, so I can certainly feel the pain of a lot of folks who are on this webinar and listening in, who are managing the intercompany. It's very manual, it's very complex, and if you're on the treasury side, just managing the cash settlements, it's just a complex process. And you know, getting intercompany transactions right the first time is key to preventing the downstream mess. And you can see all the different stakeholders here: treasury, financial planning and accounting, tax, and you see all the complex entities involved, the parents, the subs, the plans, the operational aspects, and you see how you can ask, Ernie, one of the things I tell everybody, you can ask 3 different people what intercompany means to them. You're going to get 3 different answers because you've got folks in treasury. To them, it's settling cash from intercompany or settling even non-cash and having intercompany loans. You can talk tax and talk about tax leakage and BEAT and BEPS requirements, or trying to tighten up their effective tax rates that are resulting from intercompany. So all of these things, transfer pricing, tax invoices, it's all the complexity when we take intercompany, and the complexity only compounds when you have a large organization. The larger your organization, the more chances are you're going to have multiple ERPs, the larger the teams, and those teams are very siloed. And so that's the problem. So what's the solution then? And the solution is intercompany financial management solutions. And so there's this, we call it intercompany financial management because the intent is to encompass all of those siloed entity involved in the intercompany and tackling all of those technical issues around intercompany that cause all the problems. So new intercompany subledger to manage and automate your intercompany transactions across the globe. And if you have ERPs, across ERPs. The kinds of problems that we solve today, challenges you're facing today. So we explore the value intercompany operations excellence brings to your organization. Those traditional methods on the left is the consequence of not having a solution in place. On the right-hand side is the benefit of having a technology solution in place to manage your intercompany. The intercompany operations excellence gives you 4 primary things: automation to support efficiency and capacity gains for your accounting and treasury teams. It's having a single place to manage your intercompany. New intercompany subledger, that's what this is. The technology solution is having an intercompany subledger. It's your strategic tool for enforcing accuracy for your intercompany transactions, giving you confidence in the transactions for tax controls and compliance. That's that gain global tax control second piece there. The third piece, up to 80% of your value chain transactions are intercompany. That's a very important thing to keep in mind. All of the transactions you do are mostly with yourself. Error in these transactions directly affects your P&L. It's not just a left pocket, right pocket, because if you get the transactions wrong, suddenly it affects your tax rates. You're going to have write-offs. Your transfer pricing, are you using the right transfer pricing rates? Or keying errors. And then that last one, ensuring cash precision, whether you settle your intercompany in cash or non-cash. Intercompany subledger helps you better manage your current state of cash, but also to have some visibility in your cash currency forecasting.
All right, Wade, thank you very much. I'm going to go ahead and take the floor here for a while. So thank you so much. So really what we're going to do is we are going to really drive through. So in September, I launched in partnership with Blackline, Intercompany Financial Management Benchmark Challenges and Expectations Survey. Really excited about this for a number of reasons. First of all, I looked around to see if there was any surveys ever done on this, and I found a pretty good one by 4Q, who was acquired by Blackline. But it was somewhat of an open field here, so I know the research is really needed. And so so before we dive in, let's go ahead and look at our survey demographics first. I have gotten much more into surveys this year. And so I think I've probably produced white papers on, I think, 10 surveys this year. So getting back to my quantitative background. I'm really an econ statistics person. So before I try and make any inferences, I really try and tame my commentary around what those survey demographics look like. So obviously I want to take a look at the job titles, right? Right, is the company size. We have industries. We do our best to see if people are really qualified to answer the survey. So we have some qualifying questions. So as far as job titles are concerned, we had a really good mix of job titles in here. A lot of folks, the accounting managers, that a lot of places, that's going to be your bottom line: finance director, controller, chief accounting officer, treasurer. And so you can start to see the number of folks involved there, and those folks that have a really good grasp of that demographics. Wade, do you have any thoughts on the titles here? Is this what you expected? Is this what we like to see, or what do you think on that?
Exactly it. Yeah, exactly. And so, if you guys remember that first slide, it's kind of a messy one, but we involve the tax as well, treasury, accounting. So everybody plays a role in this. Yeah, perfect. Thank you, Ernie.
All right, thank you. All right, so let's go ahead and dive in a little bit. Let's get our demographics going. All right, what about our company size here? Not real surprisingly, I mean, we see a big tilt towards what I would call enterprise. And so this is number of employees. So for me, when I classify company size, when I look at folks over 1,000 employees, that's my definition of enterprise. And so we see the highest percentage in the 1 to 5,000. Then we've got we've got 5,000, or sorry, 500, 199, just below that in the mid market. And so, and we've got a good mix over 10,000 as well. And so part of that is just the complexity, right? You don't have to be a huge company to have intercompany operations and complications, but those are highly correlated as well. So when we look at any survey results, when I talk about company size, I'm referring to, I believe I classify a small 0 to 99, then we get from 100 to 999. That will be what we'll call mid-market, and then we'll talk about enterprise as well. And then the other thing I want to mention is we had a really good mixture of industries as well. And so where you stand depends on where you sit, of course. And then if you want some more detail about the slices by industries and things, I'm happy to have a conversation with you. We got to be a little bit careful on those inferences as those sample sizes really go down. I forgot to mention we had, I believe, over 260 folks across the U.S. respond to the survey. So on aggregate, we had a pretty good sample size, but we got to be careful if we're digging too far into industry. So one of the things that I mentioned we're going to talk about is why intercompany matters. Here, some folks, even if we have intercompany, to be honest, we had intercompany and I was in Treasury, I didn't know. The big thing that it matters. This is one of the survey results that really shouted out to me why intercompany matters here, right? So we see the value of intercompany interactions versus revenue. So obviously, only 12% have less than revenue, and we've got over the majority 3 to 5 times revenue and 6 to 10 times revenue. So Wade, what are your thoughts here? And can you give us a definition of what do we mean by revenue as far as these transactions go?
Yeah, so keep in mind, as I mentioned before, that the intercompany can represent a huge chunk of the revenue. Even though it's not third-party revenue, it's still revenue between yourselves, between the entities underneath your company umbrella. And that can be 80%. That's a huge piece of that. So your intercompany interactions, your intercompany transactions can be significantly more than just your regular revenue stream from B2C, B2B kind of transactions that you do on a regular basis. Yeah.
Okay, great. That one was actually, I'll be honest, was surprising to me. Do you think folks like outside of those that are doing this understand that? To me, I don't think that's the case, but this really sticks out. Do you think we talk about that enough? What are your thoughts on that whole? Yeah.
Okay. Intercompany has always been the red-headed stepchild, I guess, in a way of putting it, in terms of just there's no solution out there. This is a manual says, and who cares anyway, Ernie, because it's left pocket, right pocket, right? So there's no impact on intercompany. I don't need to settle more often. I don't need to resolve out of balances because, and it's just not the case. And the fact that so much of your revenue-based transactions are intercompany just compounds the importance of why we should have these conversations.
All right, awesome. Thank you. So just to dive a little deeper into why it's important. So we asked several questions around trying to assess, right, what's the impact of intercompany operations? Does it matter? Why does it matter? So we asked folks to share with us how intercompany challenge do or do not impact business outcomes, right? Business outcomes, what does that mean, right? The bottom line, right? Our company's growth, our profitability, our competitive advantage. And so impact business, increase in SEC investigations, nobody wants that. Uncertainty, right, causes overdue or unsettled balances. But some of these things may cause us to, when our auditors get to us, our lovely auditor friends, what happens if you're a CFO and you restate your financial earnings? Oops, you might be looking for a job. Missed tax deductions opportunities. I think this is really a place, and Wade, I'll talk a lot more about that, where we have some significant challenges. And then to me, that 16%, to me, as a senior finance person, that's the thing that really sticks out to me. But maybe it's because people don't understand how intercompany gone wrong is really a key driver to that for companies that have reputation risk. So I'm going to go ahead and launch our first polling questions. We're going to have a few more than normal, but I just want to get some data, and I want to bounce off what we see in the audience versus what we see in our polling questions. So I'm asking you to share with you, right, which impacts on your company. And so one of the options is it's not applicable, right? Obviously, if you don't have intercompany interactions, again, you can select more than one. Do you see increased staffing costs, complex disputes? The other options as well. I want to remind everyone, if you're interested in receiving a certificate of attendance, you have to answer all of our polling questions. For those of you who have taken your valuable time to join us today, it would be much appreciated if you could just give us a click on the button here. It only takes a second or two. So I'm going to go ahead and leave the polling question up for just another 10 or 15 seconds, because as always, we've got a lot of content to get through. I absolutely want to make sure that we leave Wade adequate time to show us how technology is going to help us address all these issues that we are going to see that can be caused by intercompany gone wrong. And a lot of times for me, it seems like it's just there's not visibility right into these things that are causing problems that really get up the chain, and they're not quantified or qualified. So let's go ahead and close the polling question. Let's go ahead and share the results. So you're going to have to keep these in mind. So we're going to compare these to what we saw from the survey. Leading the way is additional time needed for reconciliations. And then we have a pretty big mix, right, over the other ones mentioned. Looks like 24, 28%. And then we've got some of you that may not be involved in intercompany yet. It's something that maybe you'll be seeing. So it's good to stay abreast on what's going on, but also some of the issues that we'll raise on the intercompany front are things that you should be looking at anyway in the efficiency of your accounting and finance, and especially your pricing issues in managing your FX risk and your currency risk and all that good stuff. So let's go ahead. Thank you for taking the time there. So what we've seen here, we saw reconciliations, right, pretty high, 50%. But we saw, additional time, 50%, compliance and formal disputes about allocated costs. I know that was going on behind closed doors, where I used to work at Franklin Electric, so that was a lot of time. And then increased staffing costs. We'll talk more about that later, but to me, this is something that is probably something that has gone under the radar, so I can't imagine how frustrating it is every quarter to just manage those transactions, but also the reconciliations when things aren't really lining up. So really good, the top thing, compliance and formal disputes. And I would say in general, folks that face intercompany transactions, they're probably going to face all of these impacts. So I'm going to go ahead and ask another polling question here, keep you on your toes. So just asking you to share which of the challenges listed has the largest impact on your finance and accounting team. Again, if it's not applicable, just go ahead and select that for us. Again, if you're interested in receiving CPE credits, you'll have to answer all the polling questions. So stress causes potential mental health issues. For me, it used to stress me out just watching people trying to close the books every quarter. Increased churn means loss of institutional knowledge, which I can't tell you how valuable that was. At my organization, there was one person who understood all of the intercompany workings, and that's a big risk, I think, that a lot of companies face. You have that institutional knowledge in one person, especially if that's not automated, right? It's not something you can easily get at and replicate if you lose that person. Staff demotivated, tight close. So let's go ahead and give you guys another few seconds here. Then we'll take a quick peek at the results, and then we'll see how our survey respondents, how those relate to what we've seen in our audience today. I'm gonna give you a few more seconds. Thank you so much. Let's go ahead and take a quick peek at the results. So the most prevalent among all those was tight close deadlines, right? Those extreme hours right around the close. We had employee churn, right? That's what I mentioned is really stuck out to me and what I was thought of, but also to me, staff demotivated. I mean, I think all of these are related together, but to me, having to chase that same information, I wasn't involved in intercompany, but I was involved in just collecting like global insurance information and claims and benefit plan actuary data, and that can be extremely frustrating there. So, Wade, let me go ahead and bring you in here. Does what we're seeing from our audience, so what do you think about those? And from your experience, from when you were working, is any of these more prevalent, and then are you seeing any trends of these getting even higher?
Yes, absolutely. There's a common theme going on here with these responses, and that is a lot of the folks on this webinar are experiencing large out of balances from intercompany. And that's what extends the month-end close, and that's what takes more time in that month-end close. And that's what makes the reconciliations more complicated when you have to resolve out of balances. And sometimes you have to wait till the month end to discover that they're out of balances. And then you do the, as you say, Arnie, behind the closed doors, it's the arm wrestle and who's making the entry for that. So right. I see a common thread here for sure.
All right. Thank you. All right. So just to take a look at from our survey respondents, again, I kind of knew the answer, but this to me would just stress me out. Increased employee churn, right? You get folks that are getting frustrated, and then you have that churn. You lose that institutional knowledge, so you don't even know how to get those reconciliations done. You don't even know who to contact, right? You don't really know who's involved in the process. There's no visibility. There's no tracking, right? There's no place to put notes in why or why not, ask questions in real time. Wouldn't that be nice? So just another thing about the impact of intercompany operations, and I was going to ask a question, but I think I know the answer on the right side. So we asked folks, what's the largest material variance during the close process? So so I think anything above $1 million is going to give anyone a lot of heartburn. But then the highest level of escalation, right? How is it nice? Do you want to go to the CEO or GM to resolve these disputes? Right, so I think that's what we'll see is there are a lot of material variances that are being caused, right? A lot of root causes, but some of those we can take care of with the right technology and the right systems in place, processes. But then this escalation place, right? You're just going to give you heartburn every quarter if you have to go to the VP and director, right, to resolve these big variances. That's the last thing that you want to do is go to your boss. If you're CFO, go to the CEO and say, oh, I don't know how to do our accounting, right? Or go to the controller, go to your CFO, oh, I don't know how to get the accounting right. So that's something that I don't think anyone would be too happy to deliver that message. So let's dive in just to get a level set of course, all these companies and people surveyed, they have intercompany operations. So it's from the standpoint of those that we surveyed in our survey results. So to take that with a little grain of salt. So let's talk about how they're managed. This one to me really stuck out. The centers of excellence were 55%. So I was happy to see that. Shared services, centralized. I like that. I don't know how you do this in a decentralized environment and get it right. And then number of people involved, like this one, holy cow, right? You have more than 100 people, right, involved in anything. So imagine the stress on there, 51 to 100. So Wade, I'm going to have to pull you in here. What
Sure.
about the centers of excellence? Are you seeing this more? And then on the right side, how did you manage to get all these people involved, aligned at all, ever?
It was complicated, right? That's the silo effect. Everybody's there focused, and tax doesn't care what treasury's doing. Treasury doesn't care what accounting's doing, and so
Yeah,
they piece of the pie. They know what they need to focus on to get it done. But without technology and a way to collaborate, it's really difficult because they're not having meetings about it. At least not enough.
yeah. Did you guys have a center of excellence? Is that something that's more common now, or are more companies doing this, and do they work?
So we are seeing more centers of excellence being
Yeah.
created. So shared service centers is the model that I came from.
Okay.
That designed of pooling knowledge and the efforts
Right.
together for a single cause for multiple operational units. But
Yeah.
the center of excellence extends that concept to bring in
Right.
to bring in tax for more
Right.
holistic. Yeah.
All right. Thanks, sir. All right. So as Wade mentioned, shared services is still probably the most common. So we wanted to share some of the challenges that people have faced from our survey respondents. I'm sure they're common. Those of you who have the shared services model, some of it is just inherent in the design. Processes are manual and efficient. So we ask folks to share. More difficulty resolving disputes. I mean, you're putting someone in the middle. That can be good and bad. Results are less thorough. You don't have the detail, and they are not as accurate. So Wade, just let me ask you real quick. Which one of these would you say was most challenging when you were back in this game?
Not having visibility to data. So that
Yeah,
difficulty resolving disputes is huge. And it's a
yeah,
manual and inefficient way of getting to the data you need. So there's a lot of time spent just researching and trying to figure out what actually happened, what went wrong. Was it just
right.
are we charging just the wrong entity? Did we use the right transfer pricing? Did we use the right tax? All these details.
All right. Thank you. All right, so let's go ahead. And then we're going to talk a little bit about technology. We'll have Wade dive into this a lot more later. Just wanted to really assess, right, how effective ERPs are in helping solve these challenges. It's kind of, it almost dictates, right, part of the onus or the business case, right, is there something better than our ERPs, and is it even on the radar of our ERP providers? Sorry, ERP providers. I think the answer to that is probably no. But only partially solves challenges. Almost 3/4 of the folks, and then we look at company size. I just did mid market and enterprise, and so you'll see mid market is even more unhappy. So I would say, to me, the important part of this is that we see in general. I would characterize this as a technological immaturity, and part of that just might be that people don't know that there's anything out there that's better, and that's part of our mission today. And then it's interesting. I wanted to see the types of automation that were being used. Just really just the general tech stack here. So we see close, FP&A, consolidations, treasury, tax. And so to me, it looks like it's a pretty good mix there. So Wayne, let me go ahead and ask you. I'm sorry, I meant to ask you on the previous slide about the ERP information. Is there anything that sticks out to you there?
One thing that so it's important to remember that there are two types of intercompany. There's trade
Yeah.
intercompany and non-trade. Trade is
Okay.
used. Those are your products. That's your inventory, your services that you sell. And you sell to yourselves sometimes. If you're manufacturing, might be a sub-assembly for further manufacturing. You're you're trading with yourself, your own customer, you're between your subsidiaries. So the trade aspect of intercompany, and this is an important concept. Your ERPs are generally pretty good at that. It's trade. That's the open market. That's the area of your complex allocations when you're distributing your HR, IT, advertising, legal costs from corporate to your subs, for example. You get a lot of invoices that corporate's paying on behalf of a sub. Those are cross charges or recharges. High volume recharges. Those are the intercompany loans. These are the kinds of areas that is not solved in the space with technology until now. And that's what we'll talk about later.
All right, perfect. Thank you. So to me, this sticks out. I mean, I think we would see, I would say, we had some, from what I've seen in all my research, some pretty tech savvy folks in terms of the automation already being leveraged. I'm a treasury guy. I love to see treasury cash management. Also was a little surprised, but happy to see consolidations. But again, if you're doing consolidations and you don't have intercompany in there, I think that's a big miss. But the good news is, if you already have that culture of automation, you see the benefits, and all these are related, right? Consolidations, intercompany, financial close, right? So all those should go hand in hand. So we want to look at having I would say, a coordinated strategy there, because intercompany can help you improve all these, not only from a accounting side, but also from the efficiency side, working capital, capital structure, all that good stuff. So I just wanted to touch on that. Again, I just wanted to put this up one more time, just so it rings clear. If someone wants to know why it's important, if you don't measure this, if you have intercompany, I strongly encourage you to do that. What's your value of intercompany transactions versus revenue? Hello, 6 to 10 times. Okay, I bet your CFO and your CEO are going to be pretty, they're going to be pretty engaged when you throw that number out there. And then we wanted to just see because obviously when you're dealing in multiple currencies, this becomes even more complicated in your transfer pricing, just even estimating and managing your exposures as well. And some of these things are just caused by transactional nature. Are you invoicing them in the right currency? You're settling in the right currency, all that good stuff. And so we see, not big surprise, but euro. But what did stick out to me was the amount of different currencies, right, that we saw across our survey respondents. So currencies matter, and it's really a mix of currencies, with the euro leading the way. So let's go ahead and want to just level set. I mean, this kind of sets the stage for technology, and really focuses on a great point that Wade made earlier, the frustration, the visibility, right? Communications and relevant information, right? So that's really what I see as maybe the biggest inherent barrier. I always say you can't manage what you can't see, right? So I'm just asking you guys to share with me. I'm not going to tell on you if it's poor, is it decent, good, you have blind spots, perfect, or obviously if you're not in intercompany. Then we'll go ahead and we'll take a peek at where you guys stand here on the attendees, and then we'll take a look at what we saw in the survey results, and then we'll see how we can align those results and see what Wade's thoughts are as far as what we're seeing from you guys, but also what we're seeing in the market. And so let's go ahead. I'll give you guys another few seconds. Go ahead. I'm gonna give you a few more seconds to go ahead and answer. Please just give me a click there, and then we'll take a quick peek at the results. Let's go ahead and close that. Let's go ahead, share. So I would say we got 6%, perfect to see it all. I'd like to talk to those folks after the webinar and really know how you've been able to accomplish that. And then we've got good, blind spots. So everyone, besides 26, over 3/4 of you on the webinar, hopefully when we show you what technology can do, the business case for leveraging technology is going to become self-evident. Wade, any thoughts here?
I just go back to Ernie, the bigger the company, the bigger the problem. And so
right.
I would suspect that the folks who are able to see everything, hopefully they're all sitting in the same room and could, they have that visibility and they have access to the right resources. if you're decentralized, to your point earlier, Ernie,
Yeah,
if you're decentralized, it really just makes it a much more complex,
right.
not for intercompany, but for all of accounting.
Yeah, I think one of the things that just kind of came to my mind is, as I was thinking, was that, there, when I was involved in a company, that we had a lot of intercompany that was going on between our divisions, and it was just the US, right? So that's complicated enough. But as we start to go across borders, that's when all these other issues can come in addition, especially on the currency side. So just wanted to kind of point that out to folks. So intercompany is complicated. There's a lot of things that go into that. It's not all. It's not just about trying to settle things when you have transactions across your borders. So we look at this pretty consistent with what we saw, blind spots. And so if you got blind spots, we can do better. And what I would say with that is, what are those blind spots causing you, right? What headaches are they causing you? How are they impacting the risk of your restatement, your staff, your motivation, your retention, right? And all the other things that are important that we'll talk about, bottom line impacts of the intercompany done right. So we've got here your intercompany challenges. So we just wanted to get a sense of what those might be. So several of those. So to me, it seems like, I thought the percentage would be a little bit higher, just because I would think that most of these everyone would face. So we've got on the top side, we got the top three: lack of company-wide view. We talked about that. In ownership, I think that's something that is difficult, right? Especially if you get that shared service center, who's accountable, right? Who's accountable? How do we even identify the bottlenecks, let alone resolve them? And then legal entities are going to complain, right? So that's just some of the natural friction. So Wade, any thoughts here? Anything stick out to you? Any of these lower than you would have expected or higher?
When you have, again, it's compounded when you have larger teams, multiple ERPs, multiple source systems, multiple systems of record for accounting and treasury. It's and the fact that of everybody being siloed, the lack of ownership, none of these surprise me. Accuracy of allocations, everyone's going to complain. And it's because of lack of visibility and lack of collaboration and tools that facilitate that communication. Because if you can see what's coming that's going to hit your books for a particular allocation, you can budget for it ahead of time. You can have cash currency ready for settlement for certain things. And so it's just being able to see what's coming, and having ownership is all part of that. Just the governance around intercompany, that is part of the collaboration aspect. So none of these are really to me.
All right. So now we're going to get. So I think we have seen the lay of the land. There's a lot of challenges. They're not understood. Intercompany matters. And so I'm going to let Wade lead a discussion here on how technology really can be an enabler of intercompany financial management done right. So Wade.
Thank you, Ernie. And so we've talked about the problems, we've talked about the challenges, and now let's talk about the solution, because there is one out there. And when you look at, remember I mentioned earlier, if you can ask 3 different people what intercompany means to them, you can get 3 different answers. When you look at your full end-to-end, the entire intercompany process, not just your piece of it. So if you're in treasury, you're looking at the netting and settlement, what's happening upstream in the reconciliation and during the month end, what's happening on the actual operational creation of those intercompany transactions. We talk about it in 3 categories. Create is the creation of those intercompany transactions. There is a solution. The black line is the name of the software technology company that has created a solution to automate the creation of non-trade transactions. Balance and resolve. This is the result of transactions being created wherever they happen to be created in the ERPs, ad hoc, of your intercompany that are out of balance, and you're not discovering that out of balance until month end. We provide a way to have visibility and collaboration to balance and resolve intercompany transactions as they happen, during the month, not waiting until the end of the month to discover those and resolve those, all the way supporting the treasury teams downstream for that third piece, netting and settlement. So these are the three categories or functional areas of the full end-to-end intercompany, if you will. And if you look at it this way, an automated pass-through solution with tight data governance allows you to not only process more data in real time, but fewer errors means less time spent identifying and reconciling out of balances every month end and being able to settle cash sooner and quicker. And we do this by preventing the mess up front and getting the transactions right the first time. So then there you go. This is the traditional method. You're spending a lot of time. We saw the polling results. I need more time during month end close to reconcile my intercompany. Well, that traditional method, that pink bar for balance and resolve, that's what we automate. You're going to know on a daily basis what your intercompany out of balance is. You're going to be able to resolve it on a daily basis so that by the time the month end arrives, those reconciliations will have no exceptions. They will be in balance. So that saves you time on the back end. Well, the new method also means that we can automate the creation of your transactions. We're getting the transactions correct. We're managing the relationships between your trading partners. Those are your entities. Who maybe it's the recipients of the allocation, who can receive this particular cost. All of these relationships, most of my customers will tell me, our users say, the biggest cause of our out of balance was we were just charging the wrong entities the wrong amounts, and they're hitting the books at the wrong time. And that's the biggest problem. So if I can automate that and systematize that, codify that, that's going to be automated, and those errors just won't happen. So we're fixing the stream so that the balance and resolve has very little impact on your month-end close. So just think about how much time you're spending during that month-end close. We're going to eliminate that. And the netting and settlement, what is eligible to be netted and settled is what is in balance. So if everything is in balance, everything can now be settled more efficiently and quicker and sooner.
All right, thank you so much. Let me jump in here. I should have asked this polling question earlier, so you can really harness when we talk about the technology, the value there. Just asking folks to share with us what are the significant driver of intercompany challenges. What among these is the biggest pain for you? Is it tax audit requirement certainty, volume and value of reconciliations, document requirements, lack of integrated systems? So please take a second for us, do that. And so to me, obviously, I mean, it's easy for me to say, I talk about tech a lot, but I think it's going to become clear as Wade goes on. You can see that there's a technology that really allows you to take care of all of these issues, but you want to be thinking about it and how do I quantify that value, right? Just to me, it's the time spent, not only the employee retention, but just the time spent, the hours spent. So if you've never done this, I would say try and benchmark, right? I know it's hard, but you do it once and you can see the value of how much non-value add time across your whole company, which I can't imagine how mind-blowing that might be. So let's go ahead and give this a quick peek at the results here. Not too much time. I want to give Wade some time here. So let's go ahead and what we got. So we got growing tax and audit requirement. So pretty even there. I think lack of integrated system. So to me, it shows that that technology is really something that you can see that at our root cause. So let's just take a mental note of that. Then we'll take a peek at what we're seeing in the survey here. So we look at the key drivers of complexity and challenges here. I'll turn the floor back over to Wade and let you make any comments here, and then we'll get back to the tech piece.
Absolutely. This is exactly what I expect to see, everybody. This is the problem's not getting better. Is the problem is intercompany getting easier? That'd be zero, right? So what we're seeing is growing complexity, growing scrutiny, growing regulation, growing out of balances, because business isn't getting simpler, it's getting more complex. And if you're a growing company, of course, you're going to see more intercompany. And that there's some folks who are saying, well, we don't have intercompany. You don't today. Hopefully your business is growing, you will tomorrow. And just know that there are solutions out there that can help in drive automation and data governance around accuracy to make sure that that their transactions are going in correctly, being processed and charged out correctly, where there is no more disputes, there is no more out of balance to have to mess with during month end, and then your financial reporting is accurate. At the end of the day, we're giving you that virtual subledger, and the way we do that is through automating your cross charges, or some folks call them recharges, and that's through billing routes. So you send the invoices into a system. The system then knows who to bill that out to, because you're doing a pay on behalf of, and we generate the journal entry, post the journal entry, and creating any tax invoices we need to. If there's any uplift, we apply the uplift. That's either cost plus, that's your transfer pricing piece of it. Obviously, we're going to apply indirect taxes and any currency conversions necessary. Same for service type. Think of that as allocations. You have a single expense or collection of cost centers and accounts. We accumulate that, distribute it to your subs as appropriate in an automated way, again, with any markups for transfer pricing, any indirect taxes, withholding, or VAT taxes. So it's tax compliant, and that's the output of that is your tax invoice, and that's your official documentation for compliance and controls of tax and passing your tax audits. This is all, again, 100% automated. It's a flow-through process designed in the virtual subledger. We call it it's your intercompany subledger, and that's truly what's missing today for everyone. There is
Can I?
Sure.
Sorry, can I jump in here? This one just is really important to me. The tax compliance, right?
Mm-hmm.
So are those rules automated in logic? Are those things the companies need to stay up to speed on, or is that something the system does? Because that's a huge thing. That's really complicated, and all the VAT, all that good stuff. Sorry to interrupt you, but to me that really jumped out to me when I have my practitioner hat on.
Absolutely. This is the biggest reason to move to an automated technology solution is for tax compliance. Some folks ask me, what does intercompany operations excellence matter to CFOs? I think that's our ultimate question today. And the answer is, it's your get out of jail free card. Okay. What that means is tax compliance is hugely important in the sustainability of the operations and maintaining integrity and reputation of the organization. The tax rules, this is now the tool that the tax teams can manage the taxes as they're supposed to happen for intercompany. They may be using another tax system in an ERP landscape, but that information is fed into Blackline. Blackline then applies that tax logic and does the calculations for you on each and every transaction based on jurisdictional requirements, whatever the tax rate is for that jurisdiction for that given period of time, for that type of transaction, et cetera. And then the output is the invoice, the tax invoice and e-invoicing capability to document what actually happened is accurate for tax compliance purposes. Very important.
Okay, sorry, thank you. So I believe you were getting into the virtual subledger piece. I got excited because I was like, that's really important.
No, that's okay. And I know we don't have a ton of tax folks on the call, but again, that's the siloed aspect. We have a lot of treasury folks and we have a lot of accounting folks as well. But let's not forget our tax teams and what they're having to do for intercompany as well. And this is your virtual subledger. This is your new intercompany subledger. These don't exist anywhere else. Blackline is the only product in the marketplace that has the intercompany subledger. Why do we say that? Because we're a full end-to-end for everyone. It's a single place, single version of the truth for all of your intercompany on a global scale, regardless how big you are, how many ERPs you have, and for all teams. And so this is just wanted to give you this is the automated pass-through solution. This is we talk about, if you look on the left-hand side where it says create, it's in blue. That whole section, this is sort of the subway slide, subway map slide, if you will, of all of how the data comes in. We can bring in vendor invoices on the pay on behalf of. We can pull in data sources that are going to be allocated out. Any intercompany loans, and there's going to be a validation process. You can have automated and manual review processes for large volume, large dollar amounts. You can have approval steps in there. We do the recharges, we can do the allocations, all of the outputs for invoicing and the journal entries are booked, and then that takes us to the balance and resolve piece, so that the system is still policing all of the data, whether it originates in Blackline or your ERPs. We're still going to police that. We're still going to see it. We're still going to know, and we're going to notify if there are any exceptions. Those are your out of balances. But we're not going to wait until the month end to do it. We're going to do it every single day. You're doing intercompany transactions every day, so let's give you your exceptions every day. Resolve those during the month. What is resolved gets sent over to netting and settlement. If it's in balance, it's eligible. So that eligibility flag is set for anything that's in balance, everything that's ready to go for Treasury to do their piece on the netting and settlement, whether you're using a third-party system like Kyriba, SAP Treasury. There are a lot of systems out there that for treasury management and cash management, we interface with that. We can also interface directly with the banks. And so the idea here is to make it one single line, one single seamless, streamlined process that can be fully automated. This is I wanted to ask the audience and ask yourselves, when you look at this slide, which one of these applies to me? Which the kinds of use cases for intercompany that really applies to me, and the kinds of things that we have challenges with. Sometimes it's management fees and the complexity around that. Sometimes it's transfer pricing. Sometimes it's tax. But these are the kinds of examples of why you would have recharges, of why you would have intercompany transactions, maybe allocations. I have parts and spares and finished goods as well. That's for trade intercompany. So think about what applies to you. These are all use cases that we manage with our existing customers. And I mentioned before, this is now, and I don't expect you to be able to read all these slides. This is just a visual of the product itself. You now have, because all of the intercompany transactions are going to be brought into this solution, Blackline. You're going to now have a single version of the truth for all intercompany. This is where you go to find out what's going right or what's going wrong with intercompany. And this is called your intercompany subledger. ERPs don't have intercompany subledgers, but Blackline does, and we sit on top of your ERP. Because we have all the data, and because you now have a new intercompany subledger, you're going to now have reporting capabilities for tax controls and compliance, for intercompany itself and what's going on with it, my intercompany reconciliations, customer information, product information, my transfer pricing and tax rate information. All of these things are now accessible from a single view in a single system now. So you can see, the more complex and the larger the business that you have, that you're a member of, you can see how this can really kind of explode and snowball in terms of complications. Here I have a single dashboard view. I can see exactly who's trading with who, what countries are involved, what the volume that we're talking about, and I can create filters, and I can just look at certain types of products, transactions or types or periods, to then have a better view of what's going on with my intercompany. So the global, when we talk about tax again, it's all, there's so much that we're benefiting for tax that ultimately rolls up to CFOs. That the idea here is just making sure that we have visibility to manage, do we have the lowest possible effective tax rates for each jurisdiction possible? And having tight data governance and tight access to the data is how you get there.
All right, thank you so much, everyone. Or Wade, I should say, and thank you for sharing that. I just want to give everyone a flavor of what the technology looks like. Again, This is the leading technology out there, and that's why I wanted you to see what's possible. I think sometimes we don't stay on top of that. So that's kind of why I do what I do, and that's why I let Blackline dive in a little bit on what the technology looks like. Of course, after the webinar, if you'd like to see how this really fits with your company, I'm sure we can set up that conversation with you and really understand what your challenges are all about and if the technology might be the right fit for you. So just ask folks, get back to the survey a little bit. What about how do you stay on top of these, right? Different internal tax, big four tax consultants. For me, you need tax consultants. I wouldn't say you don't need them, but having a lot of that compliance embedded in the software to me could be a huge expense saving if it makes sense. I'm not giving you tax advice at all. It's just a point that internal tax expertise is part of that's going to come to you as part of the value offered to the solution, which is huge. So let's take a quick peek here, and we only have a few minutes left. Just wanted to share with you a couple of things about what's going on in 2023. So just ask you to share with us what do you think your biggest challenge is going to be going into next year. Again, is it going to be the same? It might be different next year. Is it going to be that lack of visibility, supply chain disruptions, inflationary environment, volatility? So I'm just trying to share with you really some of the external factors here and just see if those macro factors are really going to have an impact. Which of the macro things that you really don't have control over is going to have the biggest impact? I'll give you guys another few seconds. I wanted Wade to dive deep, so I'm going to go ahead and close the polling question here in a few seconds, make sure we have time. The good news is happy to give you a copy of the slides, and also we are going to have an amazing white paper that we're working on right now, which you'll be able to get with the survey results. Let me go ahead and close the survey results. Let's go ahead and take a peek here. Looks like the biggest one is the inflationary environment. We'll see how that plays out. I think we slowed a little bit here in raising rates, but again, we see that visibility there, right? That's really an internal product, but then we have FX rates. Supply chain is probably a little lower than I thought. So just taking a look real quick at the survey results. Visibility, right? Inflationary environment and visibility. Supply chain was a little bit more prevalent. And then we just wanted to look at currencies, right? We looked at earlier, pretty consistent. The note here is there's a lot of currencies going on. We wanted to see is complexity going up. Yep, number of transactions going up, complexity is going up, right? Increased significantly, right? You can see that almost 70 to 69%, right? So you're going to have a bigger challenge, going to get more complicated. And then we asked folks what the functionality is. They're all pretty even here. We talked about all those at length. So we also wanted to see if people are invested in technology. So the good news is we think there's going to be investment among our survey respondents. Going to go ahead and launch our final polling question here. Again, so what we saw is that 66% of the folks realize Houston, they have a problem, and they're going to be investing next year. So those of you out there, you should expect no less, right? Look at the value proposition, all the bottom line impacts that you can have. So it's definitely worth your while to look through those results. I have some key survey inferences, right? That I'll just hit on a few. Companies have intercompany, you face challenges that can have material impacts on the bottom line, business incomes, people, staff. And so you face diversity of challenges and drivers, but the key takeaway for me is that technology can really be a medicine for your headaches, and also it's good to get that as you become more complex, right? So let's get that under control before we become more complex with our business growth and issues. So Wade, let me go ahead and let you. Do you have any final thoughts or things you really want people to remember from our time here today?
No, I really appreciate everyone. The intercompany is a complex issue that faces most companies. There are very few companies that just don't have any intercompany at all, and those are the smallest ones. The larger the org, the bigger the intercompany issues you face. And there's only one solution provider in the world who can address these from a technology perspective. That's Blackline. Happy to support any conversations you'd like to have subsequent. Thank you.
Thank you so much, Wade, for taking your time and sharing your amazing expertise with us. I also want to thank Blackline, my thought leadership partner, for today's webinar. Look for much more from Treasury Webinars and Blackline in 2023. We have some exciting research, and there's so much more for me to share with you on the intercompany financial management side, so be looking for that in 2023. Finally, everyone, this is my last webinar of the year. Thank you so much for your support of what I do and how I do it. I appreciate each and every one of you. Happy holidays, and make the rest of your day great, everyone.